Thank you all so much for being with us today. My name is Sarah De Levesque, and I am Managing Director of Regenerative Food Systems Investment. It's such a pleasure to have you here with us. For those of you who are new to our community, Regenerative Food Systems Investment, or RFSI, launched in 2019 to address the lack of capital flowing into regenerative agriculture and food. Our mission is to create opportunities for investors, funders, and activators to learn more about investing in a new food system and to connect funders with opportunities for investment. Our annual convening, the RFSI Forum, takes place each year in the fall. We just wrapped up our first in-person forum in 2 years in Oakland at the end of September, and it was a blast to be back together in person. RFSI also serves the sector with virtual events, a newsletter, a directory, and webinars like the one we are here for today. You can learn more about all that we do at rfsi-forum.com. Before we get started, I need to go over the obligatory webinar logistics. So just please know we're going to submit questions today using the chat function. So you can find the chat function at the bottom of your screen. Just click on that, add your questions as we go along. We'll be stopping throughout to address questions. You can also feel free to share resources or ideas in that chat as well. We also can support you if you have any technical difficulties through the chat. So let us know if you're having any technical difficulties. We'll do our best. And then lastly, we love to know who's joining us at these events. So if you want to change your name on your Zoom picture, that would be great. And you can update it and let us know what company or affiliation you have as well. You can do that by clicking on the little 3 dots that are in your little image up on the Zoom screen. And when you click on that, there's an option for rename. If you scroll down to rename, then you'll be able to rename yourself. Okay, with that, we will move on to more of the fun stuff. Today, I am so pleased to introduce an important discussion brought to you by our friends at Impact Ag Partners. Impact Ag believes agricultural investment can catalyze change to address current global challenges that are impacting future generations. The team at Impact Ag firmly believes that agriculture needs to be part of the solution towards addressing climate change and decarbonizing our economy. So knowing that, it should be no surprise that they bring us today a conversation around the recent UN Climate Change Conference, or COP26, and for that, we are grateful. For most of us, it's been hard to miss all the coverage of COP26 over the past 2 weeks, but when all was said and done last week, many questions still remained, especially as it pertains to actually taking action and the role of agriculture and natural capital. Today, we have 4 experts joining us from different corners of the world to work through some of this. The panel today will be moderated by Bert Glover, Managing Director of Impact Ag Partners, and he is joined by Katrina King, General Manager of Capital Solutions at QIC. She brings more than 25 years experience in financial services and is responsible for leading QIC's product innovation and development. Paul McMahon, Managing Partner of SLM Partners. Paul is co-founder of SLM, an asset management firm that uses investment capital to scale up regenerative farming and forestry systems. And Debbie Reed, Executive Director of Ecosystem Services Market Consortium, which is a member-based organization launching a national-scale ecosystem services market for agriculture to recognize and reward farmers and ranchers for their environmental services to society. Together, this team will walk through a robust conversation, but we absolutely want all of you to be involved too. So we will pause throughout the conversation to take audience questions. So please make sure you add your questions to the chat as we go along. I will collect them for our team and make sure we address as many as possible. With that, it gives me great pleasure to pass things over to Bert Glover to get things started. Welcome, Bert.
Hey, Sarah, thanks for the kind introduction and welcome everyone. And we're really glad that you could join us today. We've always felt that COP26 was going to be a substantial event hosted by the UN, and just where markets are moving in terms of natural capital and the role agriculture is playing for investment as a nature-based solution. We felt it was timely to have this discussion, and COP26 is quite fresh. And there is, as you would all know, little snippets of information constantly coming out in the media. And so it's kind of sometimes difficult to understand what are the outcomes and what should we expect from something like this? So I'm hoping today that with the experts we've got here today that we've selected for the domains they come from and their experience in the field, that we can drive a robust discussion. And as Sarah has said, please feel free to ask questions. We're going to stop throughout the discussion today to take some of those questions. And so I think it might be time to move forward. And I think just by opening remarks, I think in the analysis that we've done at Impact Ag Partners, it seems that COP26 has made some advancements in many ways from a global perspective. And I think it's probably questionable in terms of what are the advancements for agriculture and natural capital. I mean, the fact that you've got now 90% of global GDP is covered in some form of commitment, that is something that is substantial. And the fact that you've got 100 leaders globally, that are saying, let's do a halt to deforestation. And it just so happens that Brazil is one of those. Those are a couple of milestones that I think are worth not forgetting. I think also the fact that we've got countries like India saying that, and I know at the 11th hour at COP, there were some adjustments to some wording, but the fact that you've got, the phasing out of coal in those talks, I mean, that is still a milestone in itself. So, and again, you've got a country like India that is, a developing country. We know those countries need support, and they are there constantly saying we need $100 billion every year to help us transition to create a better, more climate-friendly economy. But the fact that they're still putting a stake in the ground and saying, we're going to be net zero by 2070, and we want to be using back to 50% renewables by 2030. They are milestones. But then you could also argue that the UN has been running these meetings for 30 years now, and has our emissions reduced? No. What's happened with the climate in those 30 years? So I think it would be really interesting to get through this discussion today. I mean, it's hard to see, and the discussions we've had with those who were on site, field agriculture and nature-based solutions and discussions around valuing natural capital and nature. I think most of those commentators that we've spoken to feel like agriculture kind of got a little bit left behind in this discussion. And I think most global investors that we've been talking to, the things that they want to see action on is electrifying transportation. They want to see us drawing down carbon. They want to see us doing that whilst looking after nature. They want to clean up industry. So, it would, when you think about those sorts of elements that are important, agriculture plays a major role. So in saying that, I think it might be time to turn over. I'd like to hear from you, Debbie Reed, around what was your takeaways from COP? And I think, did you see some advancements in the discussion?
Yeah, Bert, thanks for that. I'll say, I think you're right. There were some major milestones that were achieved, certainly. But I think we should all agree that governments are not doing enough and have not done enough. So I think COP26 was a success in that it solidified the COP as the business and private sector action COP, where the greatest action and the greatest commitments we're seeing are coming from private actors. And I think that's now becoming a trend and will continue to be the case for a while. I started participating in the framework convention process at the Kyoto conference in 1997, which was COP3. And participated in most of them really up until 2016. I participated first in my role working in the Senate, and then in the White House, and then a series of NGOs, always focus on the ag and climate change mitigation piece. So it has been a piece of this, but certainly not a central piece of this. And I would say, as you pointed out, unfortunately, COP26 is literally the 26th meeting of the parties being governments. And again, we haven't seen really enough action or actual reductions from governments that have created progress. It's frustrating, but I think we can probably all commiserate in that elected officials face different constituent realities than perhaps private sector corporations. And that's at least part of the reason. Regardless, I think private sector ambition, action and investments and change will continue to be the case in the future. Here's where I think it becomes complicated. Only governments have commitments under the UN Framework Convention on Climate Change. So accounting systems, including market accounting systems, are really tracking what governments are doing and not necessarily tracking what the private sector is doing. Article 6, which is part of the negotiations, and we heard a lot about that last week and the week before, does try to address like carbon offset markets and corresponding adjustments between governments and what's happening in the private sector, and between what's happening between different countries, if you will, or across national borders. But it still does not account at all for new like carbon inset instruments or supply chain emissions reporting, which is where we're seeing much of the private sector activity and investments, particularly in natural climate solutions and ag, and which is where I think we collectively need to change our focus. So to have true global carbon accounting, we really need to account for what the private sector is doing versus what public sector actions and commitments and outcomes are doing separately, right? We need separate accounting systems. I think private sector and market-based activity is in fact generating a lot of outcomes, and the ability to track those outcomes at a much more granular level than how most government greenhouse gas inventories are being reported. They tend to be at a much coarser level, right? So what is happening in the private sector is being reported with a lot more accuracy. And I think that will continue to be true going forward. So I think government accounting needs to get better. I think we need separate accounting for private sector versus public sector. And then second, I'll say that ag is still not being adequately addressed center stage at the COP, right? I think there has been large agreement about that, despite the fact that there are huge financial insecurity and economic risks to all governments and all economies if in fact we don't address the risk to agricultural production, right? Ag is a business done outdoors. And we have already seen the increasing impacts of severe weather events, whether flooding or drought, or just intense storm systems that can devastate ag production. It has happened, it will continue to happen, and yet climate finance and risk at the international level, at these COPs, in the face of these impacts are not being addressed in a way that they need to. We've seen regional crop failures that have caused hunger and riots and security issues. And again, I think we will see those again. So it's governments who will bear the brunt of that economic and financial and security dislocation if they don't invest in improved resilience in the agricultural sector and natural climate solutions. So in all, I think the private sector activity is fantastic. I think we need to do a lot of work to bring all of what's happening at the public sector and in the private sector together and work on better accounting, particularly on the government side.
Thanks, Debbie. We're gonna talk a little bit more about the who's leading who in terms of public and private sector a bit later on. And no doubt these conferences are so, you can tell the global politicians, it's such a political thing and what they can do at something like COP and what they can do at home. I mean, you know, a lot of them are thinking about their tenure, I'm sure. But Paul McMahon, you guys made a couple of announcements, or at least one announcement I'm aware of. I mean, based on the feedback you got, how did you feel COP sort of ended for agriculture?
Thanks, Vern. Great to be here. Yeah, I had relatively modest expectations as I was going into the COP itself. You know, I certainly can't match Debbie's experience at these events. I did attend the Copenhagen event 2009, which is probably had the highest ratio of talk to action of any event in human history. So I think, you know, recognize how hard it is to get a single society to agree to anything which is multi-decadal in nature. The idea of getting multiple societies all around the world to agree is nigh on impossible. So, you know, we live in an anarchic world. And so rather than some great grand master plan, I think the best we can hope for is a more of a muddle through strategy of different initiatives, which hopefully add up and get us closer to the end picture. So I think with that as sort of my expectations, I was probably presently pleased with some of the big picture, I suppose, commitments and initiatives coming out. I mean, the big picture is we need to reduce emissions by 45% by 2030, net zero by 2050, if we're going to get close to a 1.5 degree warming target. And, and we saw, some progress. We saw, most of the countries of the world making commitments, to restructure economies in that way. We've seen commitments in coal. So I think at the big picture, there's a lot more progress than we've seen at any event before. When it comes to initiatives relevant to food and agriculture, I mean, there were a few. I think one is the big announcement around deforestation. The goal of ending tropical deforestation by 2030. We've seen these kinds of commitments before. This one looks a little bit different because probably more of those tropical forestry countries are involved, such as Brazil. So I think we'll see more and more pressure, come on deforestation. There's a very interesting news today where the European Union has actually now introduced new legislation which would effectively prohibit the use of food products which can be linked to tropical deforestation, and that could have impacts on soy, on palm oil. So we're starting to see that high level, let's say, talk being translated into actually legislation somewhere at the European Union. So I think that will have impacts on tropical commodity production in certain parts of the world. Probably the second very relevant initiative was around methane reductions, the idea of reducing methane by 30%. Now that was mostly in the context of natural gas and energy. The cow was the elephant in the room that people didn't mention in a way, and I'm sure that will get more pulled in over time. So I think you will see increasing questions asked around dairy and beef, and it's something you work on and we work on as well through a fund we manage in Australia. When it comes to nature-based carbon offsets, probably there was less attention on that than many of us would have expected, and it sort of got written out of some of the final documents. But I think it is implicit in many of the commitments that have been made. If you look, for example, the Australian net zero target by 2050, it assumes that 20% of that will come from offsets. And a number of the countries making these commitments were actually we're stating that they're going to be relying on offsets to do it. Where those offsets going to come from? Well, a lot are going to come from nature. It's going to come from forestry, agriculture, and land. So I think it's implicit that to follow through in those plans, a lot more offsets will be coming. And then Article 6, as Debbie said, defines some of those rules around how those offsets could be traded and accounted, certainly at an intergovernmental level, in a way that hasn't been done before. So that will give a bit more certainty for the market. Maybe one other initiative worth maybe flagging, something we are involved in, something called the Natural Capital Investment Alliance. That was a new grouping. It was a launch at COP. There's about 15 to plus asset managers, investors are part of that committee to invest $10 billion in natural capital, in the coming years. And we're making some small commitments around that as well through our new European fund. I think that's within the context of that broader trend, which Debbie alluded to, is around the real impetus being given by private sector. So I think there was something like $130 trillion of private capital commitments around net zero if you add it all up. So the private sector was there in force. Someone described it to me as it was almost like, the COP was turning into Davos in terms of the number of, high-flying CEOs and men in suits and, private jets flying in. So whether that's a good or bad thing, we can debate, but it's certainly a change from 10 years ago. And maybe just a final point to make is, there's some specific initiatives around food and ag and forestry, but like the bigger picture is, if we believe these commitments to be true, we're going to see the greatest transformation of almost every economy in the world in the next 20 to 30 to 40 years. And that's going to affect every single sector. It's going to affect agriculture and land use, which is responsible for about 20% of emissions. So those emissions need to come down to meet those various targets. It will affect energy, it'll affect forestry, it'll affect the building materials, everything you can possibly imagine. And I think it's relevant to all businesses, all investors. It will create threats to certain business models in food and ag, but also we think new opportunities for other business models. So I think that sort of the macro picture is equally important as you think of investing over 10, 20 long-term period.
Yeah, well, thanks, Paul. That's right, and I think it was 220 asset managers that aligned to take $130 trillion to net zero emissions, and that leads into you, Katrina. You're involved as head of product and research at QIC, an asset manager in Queensland, Australia. I mean, what did you take out of COP?
Thanks, Bert, and thank you everyone for having me. I read a headline which I thought summarised it quite well. It was neither a triumph nor a train wreck. And I quite like that summary. I'll start at home first, and I think from an Australian perspective, the impetus to get to COP with a net zero emissions target was a huge catalyst for our government to be able to reach the agreements that it did with its coalition partners going into it. So in that alone, I am very grateful that COP happened when it did before our next election, and so really enabled Australia to approach its next federal election with both of the major parties aligned essentially on a net zero emissions target, which is fantastic. But looking more at the global perspective and COP overall, I know that going into it with the pre-modelling, both a combination of the net zero emissions targets that all the countries brought to it and their nationally determined contributions, it was only enough to get global warming somewhere between 1.5 to 2.6 degrees. So they knew very well going into it that we weren't quite there. And I think that there were three things that they looked at through COP in a way of sort of endeavouring to speed it up. Firstly, was a change in timetables. So people were increasing their pledges on nationally determined contributions, perhaps from 2025 to 2022. I know India certainly debated that, but the majority agreed and pushed it through. So I'd give us an A for that. The second one was tweaking financial arrangements, and this one's about the richer countries, of course, supporting the poorer countries. In 2009, it was agreed that the richer countries would deliver 100 billion per annum to the poorer countries in climate finance. I think it's been flowing at about 80 billion per annum up until 2019, and we don't have any records for the COVID-induced year of 2020. So there's work that needs to be done there. I think obviously it's very important, and the way that it has been pitched now by the poorer countries actually might be more helpful in that they are really framing it less about just needing the money and more about really needing the money for energy transitions. They do need more. India alone is asking for 100 billion itself over, per annum over the next decade. So we're probably, I don't know, B minus, C for that one. And then finally, and I think this one might be the most exciting and one to think about, it did allow for greater multilateralism. And I think as host nation, Great Britain really tried to promote this coalition of the willing idea. It looks great, it looks big, there were some big announcements, but also some big countries missing from them. But I think that this might be a way to go forward if we can frame these big goals at the COP meetings, but then really enable this multilateralism to go and take part. And the panel here has already spoken really well about some of the things that came out of that: phasing down coal power, reducing methane emissions, greening the financial services industry, ending deforestation. So I think that model of, perhaps 5 or 6 countries agreeing to mobilize some money, helping another country, and we saw that with America, Britain, EU helping South Africa to go through its energy transition. I think that's important. But in summary, are we much closer to 1.5 degrees than we were 2 weeks ago? Maybe a little bit. But these are efforts that we need to go through. I think everything that we do that shaves off even a fraction of a degree is a positive move. And I think we just have to continue on the fact that everyone is on the same page with the goal of 1.5 degrees.
Yeah, thanks, Katrina. And I mean, I think one thing that's really interesting to me is that just in terms of geopolitics at the moment, and this has really politicized an event like COP26, is that you've got two of the largest emitters, I think China and the US, they combined are about 40% of global emissions. So, I'd be interested to hear from you, Debbie. You're in Washington. I mean, and you and I have spoken in the past about where government's going to go with this, and is government and like at COP, it seems as though governments talk about what they're going to stop doing, but there's not a huge amount of talking about what we're going to start doing, how we're going to progress, who's going to invest, who's going to catalyze this, who's going to actually get some momentum here. And I think both you and I think a little bit aligned here. It's that it's consistently going to be the private sector. So how do you think industry and sectors are going to really take the charge with this? And is it going to end up being siloed kind of ambitions? We know one of the examples I know of is the beef industry in Australia, net zero by 2030. Meat and Livestock Australia have made that pledge. Are we going to see more things like industry making their own thing and then also trying to offset their own emissions within industry? Because if we can't trade across borders because Article 6 is not ratified, well, are we going to end up with tensions across industry sectors? I mean, you're close to it. I mean, what do you take out of all that?
Yeah, it's a great question. So I think whether or not we see sectoral based approaches, right, is a good question, right? We see ICAO Corsia, where the airline industry has agreed on a global sectoral based approach to reduce their emissions, led by the private sector with lots of pressure, obviously, from federal governments. I would like to see that approach replicated. It took a long time to get that agreement, so I don't know how realistic that is. What I would say is that, politicians do, again, have different pressures that they are responding to. I think President Biden here, right, has been trying to do the right thing and package infrastructure plans, if you will, that can get us to invest in architecture that brings us to the right place with heavy emitting industries, right? I think there are some potential ways that governments can continue to finance natural climate solutions in ways that the private sector can't. I think the key will be leveraging what the private sector is doing with what the federal government is doing, right? And doing that better. I think Charlotte spoke to the idea of, multiple companies working together or multiple countries working together. And I do think there's much greater opportunity at a sectoral basis for companies to work together. And we do see that happening, right? There's a value change initiative run by SustainCert, for instance, that is trying to address some of these issues in terms of corporate supply chain reporting and how we collectively enable private sector to do that and to meet 1.5 degree net zero goals, right, within that. So I think the key will be much more integration and leveraging of private sector funds with what governments can do, and really try to ensure that we are all acting under the same rules, right, and accounting procedures. I think that's where we can see a lot more progress.
So are you thinking, ESMC, is that continue to be, funded through philanthropy and other corporates, pledging to try and help, get some proper research and markets and protocols in place around natural capital? Do you see in the short term that's what it's going to mean for you?
Well, so we will not be able to survive on philanthropy, right? We did get a huge infusion of funds from the Foundation for Food and Ag Research, right? A $20.6 million 3-year investment, 10.3 from FAR, 10.3 from corporations, right? And that has really allowed us to, leverage exactly what we're seeing, some public finance with private finance. We will need to be self-supporting in the future. And I do think we will see a lot more private sector and member-based investments helping us do that. But we'll also do that by generating credits, particularly within insets, right? Carbon insets within markets, to make us viable over the long term, right? Because I do see that's where we're going to continue to see huge and significant growth, and where collective action like a platform like ESMC's can help corporates be successful, meet their commitment, and then hopefully over time increase them.
Excellent. Well, thanks. I might hand over. I know Sarah's got a few questions there that she'd like to share from the audience.
Yeah, first question, Debbie, going back to your opening remarks, one of our audience members was wondering what it means to have separate accounting systems for governments and corporations when they manage overlapping geographies.
Yeah, so some of what was being discussed in Article 6 is trying to address that, right? But I think what has happened is we've created an international mechanism that is focused on what governments can do, with the assumption that within those boundaries, we can account for everything that's happening. But we can't, because we're now seeing much greater action within the private sector, both under offset mechanisms and carbon inset mechanisms, right? That we didn't account for 25 years ago. We didn't account for when we started this. So what is happening is we're literally creating two different accounting mechanisms that do not allow governments to account for what's happening in the private sector, right? There's just no reporting mechanism for that to happen. And so I think we're going to have to collectively work to address that and create a global accounting system that does in fact track what's happening within private sector, and separately track what's happening within the public sector, and still allow for that cross-border, if you will, transaction and trade within carbon markets. But we're going to have to take that on to have true global accounting for what is happening.
So we're not quite there yet. So we still have a lot of work to do there.
Yes, we do.
Great. The next question actually probably pertains more to Paul and the investor base. I'm happy to have it on now or save it. It's up to you. I'll throw it out there. And the question is kind of related, but are private sector investors open to delayed or lowered returns to invest in this change? Which is a very broad question, but would love to hear your thoughts, Paul or Katrina.
Yeah, I'll give a quick response. I think that there are pools, what you might call impact first capital, which is when you take a lower financial return in order to generate certain positive environmental social impacts. I mean, our experience, that pool of capital is quite small and can be quite hard to tap into. And so people can be a little bit disappointed when they go actually to try and find it and put it behind projects. I still think, by an orders of magnitude, most investor capital in the world is looking for market rate return and with a market rate risk profile. And if we want to get money to really flow towards whether it's renewable energy or natural capital or sustainable food and ag, we have to develop funds, projects, businesses which can compete, with let's say conventional or alternative approaches. So that's certainly our focus at Excellent Partners. Everything we do, we try and target a market rate financial return and financial risk, while also delivering the impacts by investing in more ecological farming and forestry systems. I think that that can be done.
I would agree. I think that was really well summarized as we talk to our own investors. And QIC, just for those of you who don't know QIC, we are a government-owned corporation that was set up about 30 years ago to run the defined benefit program for the state of Queensland. Now have 90 billion in assets under management, and about 50% of that is managed for private third-party superannuation clients in Australia. So more than just the government defined benefit plan. We've recently done a survey on about 100 of our clients and asked them a lot of these questions, and very much agree. I think about a third said that they would target impact strategies alongside traditional risk return. That doesn't necessarily mean that they would accept less risk return for it. I would agree that the pool of capital that they have for simple ag, particularly because it's superannuation, and they are pledging their members a financial outcome at the end of the day. That is the purpose of it. Risk and return is particularly important, but they are wanting to integrate ESG practices in order to enhance the risk and return. I mean, the benefit that we have in this industry that is very long-term money, it's very patient capital, and so it's very comfortable usually to be along for that ride.
Yeah, and I think as an investment industry too, and Paul, you would know this, is that generally it's that private capital that gets into these kind of investments first to try and understand can there be sound financial returns and nature-based returns, and is there any trade-offs, and this is all about demonstrating track record and a data set that says, based on a risk profile and a risk budget, we can still get outcomes, financial outcomes alongside with natural capital outcomes. Paul, I might continue a little bit on that line. I mean, you guys, and I know you spend a lot of time in Europe, and you guys have got funds in Europe. the recent movement in this carbon price, both in the EU and in Australia recently, is that really changing the way you guys think about investment strategy and what you take to market?
Yeah, I mean, I think we're always quite cautious on carbon markets as a driver for return our strategies. Given that we're typically looking to invest in real assets and in farmland and forestry, that helping local operators scale up these more ecological systems. I mean, the reality is that, for example, the European Union emission trading scheme does not allow any credits from forestry or agriculture into it. So it's a compliance market for energy, for industrials, sort of within. And so those prices are tell you something about how likely policymakers have set certain targets and are squeezing the supply of credits and prices going up accordingly. But it doesn't have any real direct impacts on food, agriculture, forestry yet. Now, there is discussions about whether, certainly probably in the forestry sector first, there should be some openings allowed for forestry credits to come in and be a source of offsets. And I think that does happen. Yeah, that could be truly transformational. Now, I think there are, though, certain parts of the world where that has happened, and is much more advanced. Australia is one, with the emissions trading fund, and there's been, we've been quite active now. We manage a fund in Australia, large areas of grazing land. We set up 4 different carbon projects with the clean energy regulator and generating over 2.5 million tons of CO2 credits over 10 years. So that's been a huge sort of game changer for income for farms and even land values, as you'll know yourself, Bert, for some of the work you've been doing. So I think, Australia is very developed, like the specific opportunities where carbon can be a real driver of return. New Zealand is the same when it comes to forestry. There's some openings in the Californian carbon exchange for forestry offsets as well. And there's a lot of activity in the US around that. But where we are active, we're also active in the US, investing in organic farming. And we've looked at a lot of the voluntary carbon schemes. We've been talking to Debbie quite a bit, and hopefully we'd love to get involved in the ESMC and try to use that in some of our organic farmland. But at the moment, it's still fairly nascent, relatively low prices per ton, more than $15, $20. And I think the other reality is that the number of tons per acre per hectare that you would expect to deliver through even a shift to these more regenerative systems is relatively low. It might be 1 or 2 tons per acre. That's an extra $20, $30 of revenue to a farmer. It's helpful, but it's not, again, going to say transform land use decisions. I think in Europe, as I mentioned before, there's no route into the compliance markets yet. I think there is increasing interest in voluntary carbon credits, and again, very nascent. But there are some interesting agriculture projects, and there are some forestry projects. It has got a little bit tied up with some of the issues Debbie was talking about before around double counting and how do you account for activities in the private sector and government accounts. We manage an Irish forestry fund.
Any day of the week except Monday. Monday
to account for forestry.
Because I'm catching up for the week.
Yeah, I'm not sure who's talking there, but I'll try and talk over them. But the Irish government effectively counts all carbon sequestration forests in its national accounts. And so it's very reluctant to allow a private sector to generate credits, which could be traded, because in case that effectively reduces the government's ability to claim on that when it comes to its overall target. So there's still a lot of, I think, confusion around public sector versus private sector activities and how they can mesh together. And that has held back some schemes. Having said that, within Europe, there are some governments who've done quite a bit of work in this. The UK have a woodland carbon code, which is working. Spain, where we're looking to invest now in some new projects, it's possible to projects. So it's a real patchwork. You have to understand the national schemes. So I think for us, carbon is often an upside, in our strategies. If we can generate offsets and monetize carbon, that's great, and that delivers extra returns. But if we can, there's other drivers of return, and whether it's about producing more high quality beef in Australia, or growing organic grains in the US and capitalizing on high organic price premiums, or in Europe, we'll be looking to invest in forestry, which is creating timber, which is going to supply that huge demand for sustainable timber and building materials and biomass, or growing, again, organic almonds or pistachios in Spain, or olive oil. So, there's all these other drivers and trends around the broader economic picture, which underpin the strategies, and then carbon is more of an add-on on top. Maybe just one last point. I do think that we're seeing a lot of extra pressure from investors. I mean, we're working a lot internally on carbon reporting and impact reporting, and getting beyond what's been a little bit of a woolly world, and slightly a greenwash world, where a lot of people making claims and there's no support for those claims. So I think we've set ourselves the target now for all our new strategies, and we want to do quite rigorous third-party verified life cycle analysis on all our investments, so we can actually calculate full emissions and sequestration, and hopefully show to investors that we are delivering these net zero portfolios of assets. And that's certainly the goal of our new European fund, which is invest in forestry and permanent crops. So, so I think we can report and have the data and show the portfolio is net zero, but maybe only 5 to 10% of those assets would have carbon projects associated with them as a subset.
Yeah, and I think that demand is definitely going to come around being carbon neutral on these real assets, and we've seen some of these new reporting standards and initiatives come to market on how we can report things that are investor ready, and we're going to talk more about ESG a bit later with Katrina King at QIC. Sarah, I just wondered, is there a couple of questions there that you'd like us to address in the short term?
There is one. This is in the investor field, but it's more kind of what are the other opportunities maybe to address climate change and the appetite. So Paul, wondering what you've seen in terms of appetite of investors in CEA or aquaponics.
It's interesting. It's not something we work on. So actually Rabobank in the US put out a really interesting report this week about organic food markets, more focused on organic vegetables and fresh produce. I think they're making a more bullish case than I was expecting actually for aquaponic systems, especially now that there's been a lot of law suits about whether aquaponics should be considered organic, and effectively that looks like they will be considered organic. And so I think there's certainly concerns on the more soil-based organic growers that these are maybe lower cost efficient non-soil-based systems could come in and start to compete with some of those high value fresh produce and leafy greens. So it's something we've seen. It's not something we focus on. I think for us, we're much more about trying to have an impact on the land, improving soil health, biodiversity, storing carbon. Aquaponics may help you reduce emissions, but it's not going to help you store carbon. That's I think where our focus is.
Yeah, it's not going to draw down, which I think many of us believe is a role that agriculture is going to have to play in terms of decarbonising our atmosphere. Thanks, Sarah. I'd like to just move on to Katrina, because Katrina, you mentioned earlier about surveying a bunch of your investors and the importance of ESG. I know you've done a lot of work on this, but can you share with us, in your experience, just how big a focus this has now become?
I think in terms of ESG, and we did survey them broadly on the question, I feel perhaps about 2 or 3 years ago, the focus was more on modern slavery, and that may have been because we did have a federal act come into play in Australia, which really ramped up the directors' duties on modern slavery reporting. That has certainly tilted now to become significantly about climate change. And when we talk to our clients about ESG, climate change is undeniably the #1 goal that they have. And we've sort of seen the social requirements under ESG still important, and sort of questions about diversity of boards and other diversity questions are still there, but I think much lower down the priority spectrum. I would say some of our clients still would have exclusion-based policies with regards to ESG and carbon emissions. I think we have been on the bandwagon for some time now about, sort of making it more about transition and trying to invest and influence change with those companies. Maybe it's also worth pointing out what is driving this change. Obviously, there's a global psyche that's happening, and I think the droughts and the fires that we've had both in Australia and the US, in particular over the last couple of years, have really brought home to people how important this is. We've had a number of class actions in Australia against pension funds brought by perhaps younger members as they come on board into the superannuation system, claiming that their pension fund is not doing enough to mitigate climate change. That has really scared a lot of the pension funds, I think, and they have really changed processes since then. We also have directors' duties being made really clear under the corporations law, and our prudential financial regulator making it clear that climate change policy is really important for investors and pension funds to follow. So that's all sort of government regulation that's helped. But I do believe it is, as we were saying before, the private psyche that is driving most of it. I'm just trying to think of some other sort of interesting anecdotes from the surveys that we're doing. As Paul was mentioning, it is that lack of robust data which has been cited as the biggest issue, and also just acknowledging that it is probably a lack of organisational capacity to be able to know about that data. So perhaps it's morphed a little bit more from reporting to data. If you can sort of appreciate the sort of the nuance there. I think people know that there is enough data out there, but it's just how to absorb it. In terms of what we're doing about it, and I guess trying to teach our own staff at all levels, from executive on downwards, about the importance of recognising and calling out greenwashing, and really trying to make sure that we're all addressing that well, and that when we do our own reporting, we're trying to understand that and the risks of that as much as possible.
Yeah, okay. So if climate change is now really the topic for the investors that you guys deal with, I mean, in terms of the products that you're taking to investors, can you share some light on what you're taking to try and address this for them?
It's a good question. We had this, sort of, I think probably 2 or 3 years ago, we were debating, do we do these green funds that are the same as the other ones that we've got, which are already sort of integrating climate principles? But is that what the market wants? Do the market want just the green funds? And then we decided, well, no, because then it makes the other one, the old one, look like the dirty fund. And that was never the intention. It is about asset integration and having sustainability built into all our assets. And so that, hence the importance of making sure the entire firm and all the portfolio managers and asset originators really understand the risks of greenwashing. So that means building into, in particular, sort of the assets that we deal with are real estate and infrastructure. So really building net zero plans into each of those and making people understand it's more than just about changing the light bulbs in a shopping centre, but really having long-term plans to keep the centres sustainable. But the interesting one is, and pertinent to our discussion today, is on natural capital. That is a place for us to actually bring something that is perhaps a little bit more of a new product to our clients, and not just looking at integration. And actually, in terms of the discussion that we're having about what is the right answer for that interaction between private and public, where I'm sitting right at the crux of that, in that the Queensland government has given us a small seed investment, so $35 million, to invest in natural capital and sustainable solutions in agriculture in Queensland, on the proviso that we increase that significantly with third-party money once they have shown proof of concept with their fund. So I think that's a really nice way for government to be involved, to take perhaps the upfront risk before the reporting is done and before the acquisitions are done and before the contracts are set, to prove to the private sector that this is that it is a minimum viable product and it is worth investing in. We have, and by very sort of nature of the fact that Queensland government wants to invest in it, it's really been able to help us attract sovereign wealth funds globally into that conversation, as well as domestic superannuation funds in Queensland and corporates. Now, what are they looking for in that fund is very different, actually, between the different types of people that we're talking to. Superannuation funds, as I mentioned before, very focused on the risk return and making sure that they still get the right outcome for their members with an ESG story next to it. Whereas perhaps more of the corporates and the sovereign wealth funds are really looking for the carbon credit unit generation, so that they can claim those offsets against their own goals and targets to reduce and help them get to their own net zero. So in designing a fund like that, you are designing for a couple of different reasons. And so I guess the trick is trying to do something that keeps everybody happy.
Well, yeah, it's very interesting. When we start talking about nature-based solutions and the word nature, I mean, making change in nature takes a long time, and you've got to have the climate with you, right? So how do you address that with in terms of the horizon of an investment, and how do you talk your investors through that? And is that through a selection process?
Yeah, it is. Look, again, maybe it comes back to the fact that it is longer term capital that, at least with superannuation and government generally, you can do. So we have many open-ended funds in infrastructure, for example, that should be seen as 20 or 30-year investments. So for some of our clients, that's not particularly new. I think the trick is to make sure that they don't see it as a private equity investment. And I know someone on the chat was highlighting that, and it's an excellent point. This is not a 4 to 6 year investment with a bit of a J curve, and then you get this huge exponential payout at the end. You need some patience. You need fantastic reporting to be able to make sure that you are on that right journey. And then we see it as a stacking of returns, being able to deliver them agricultural returns for the first few years in order to at least be a little bit of a cover for the opportunity cost of that capital. And then sort of from year 5, 10 onwards, being able to really be able to generate the carbon credit units, which they can either sell on the spot market or keep or use as their own offsets.
Thanks, Katrina. Speaking of some of the chat, Sarah, have you got another question that you'd like us to address?
Well, I have a pile of questions now. This audience is getting going. Okay, so I'll ask one more kind of investory question, and then I have some for Debbie, and we'll jump all around. Bert, you might want to answer some of these. But the first one is how can private investors just get exposure to natural assets, ecosystem services, and carbon markets? So I'd say a bunch of you can answer that one. Who wants to go first?
I can take a crack maybe. So it was something we've been thinking about and working on for more than 10 years as the sort of our business. I think, as I mentioned before, I mean, so lateral capital is what I'll talk about at the moment. I think it can cover actually 2 quite different investment strategies actually and risk return profiles. So I think that one sort of pillar people are focusing on are those carbon projects, so or other projects that will deliver some kind of ecosystem service credit or payment stream. And investing directly in those, and they can be, asset light actually, and somewhat high return, high risk, and somewhat speculative. So I think there is a set of activities going on around projects in themselves. I think the other category, which is a lot bigger, what we tend to focus on is around more real asset investing. Especially investing in land, in trees, in farmland and forestry itself. And so we've raised a number of funds and separate accounts in Australia and US and Europe to do this. I think what's interesting there is almost there's 2 different trends kind of meeting to drive appetite for that. Like one is around natural capital and climate change and ESG, all things to be talking about. The other was actually a whole different set of drivers around what's happening in financial markets, where yields have fallen on bonds and other asset classes. Long-term investors like pension funds, insurance companies, family offices are looking for diversification. They're looking for an asset which can appreciate, which can generate income. And farmland forestry assets are very attractive. You're seeing investors open up allocations, for that space. So I think where those 2 come together, that's what we try to focus on, so developing those strategies where you channel that capital, put it into the more ecological, let's say, regenerative system. So I think, yeah, there are opportunities there where, and the advantage of investing in the real assets is that you get those returns, like as we heard about from agriculture, from maybe you're growing beef, you're growing almonds, pistachios, or, corn, soybeans, whatever the crops are, or you're growing trees to sell timber. And if on top of that you can then create monetized credits, that's almost again the upside and scenario for the strategy.
Great. Do any of you guys have anything to add to that? I have a follow-up question on that.
I don't have a strong view on sort of retail investment into it. We tend to be more institutional managers. But one other point just to add to Paul's, and I noticed someone was asking about inflation and inflation risks as well. And we've just recently done a piece on what happens, what if we go to stagflation, what happens if there's this huge benign inflation overshoot and central banks decide just to continue on holding the target rate a little higher than normal, and we suffer from that. Bond markets and equity markets are particularly hard hit. I think natural capital is a little bright light there. One, because if you split it into its 2 components, traditional ag is traditionally a very inflation-linked sector, food being a large part of the CPI basket, so they do tend to move lockstep, and so you are rewarded with at least sort of nominal returns that are holding step, and real should stay the same. But then the other part of of natural capital is, of course, either the carbon credit or the eco services benefits. They are on their own trajectory. We all know that, you know, it's an asset class I'd want to be long. There's a huge transition going on, and I think as more and more people settle on their net zero plans, there will be more and more demand for carbon credits. So their correlation with inflation markets is it's probably positive if inflation's going up, but it isn't hyperlinked. So I do think that natural capital is probably one of the best inflation hedges you can think about.
I think Sarah too, we're going to see some changes in investor behavior here, as policy changes, especially around natural capital markets. Like when you start layering in what we call stacking in these carbon markets, whether it's a soil project and or a forestry project or a avoided deforestation or something, all of a sudden the nature-based returns and in this current market, they start to become a lot more attractive. And when you start offering returns like that, you start attracting a different type of investor. So one of the things and one of the trends we've seen, and for us as a business, particularly after we did the private deal with Microsoft out of Seattle, was a lot of speculators and a lot of commodity traders flocking to us saying, can I get my hands on some credits? So not so capital intensive, short term, and you know, more of a speculation in the market. Over here, you've got a more capital intensive investment in what Paul's talking about in real assets and longer term approaches. And for us, that's where, you know, when I was talking before about, you know, to build natural capital, you're working with nature and you need the climate on your side, and you need to be able to have all those practice change elements and practices to help you build natural capital over the time, underpinned by strong data. So, you know, we're seeing different types of investors get attracted to this space based on what's happening in the markets, what's happening around protocols, and different types of government changes around how they're adjusting these markets. And so I think it's going to continue to evolve. So did you have another question there, Sarah?
Well, I have a bunch, but my follow-up to that is just how far, I know that it's different in Australia and how it is here in the US. So I just wonder, how far away are we from being able to measure and get returns from these like co-benefits that are generated beyond carbon?
Well, I think you're going to see these products just as we're starting to see in Australia, but I'm here in the US right now, and, you know, people are going to come up with creative ideas of bundling and what we call internally as premiumization of products. There's going to be a premium of things around some biodiversity, some carbon, some water credit, some vegetation, and, you know, maybe some improvements in, it could well be air quality, or it could be ground cover and vegetation. So investors, you know, 4 years ago talking to us, we're talking about carbon credits. We're now talking about all the things I just mentioned. And by the way, we want, you know, best employment practices amongst your staff. We want best in class animal welfare. We want to know that you're investing locally in the community. So this is where it all becomes premiumized. And you can see a time where there's multiple different products on the market and customized, especially in private markets, in unregulated markets. I think the private sector will drive those.
Yeah, I'll add to that. So we, in our market program, we generate credits for carbon, reduced greenhouse gas emissions, water quality, water use conservation, and biodiversity. And when we started a couple of years ago, we had corporate demand saying we want the carbon. And now we're seeing a lot more demand for and the water quality and the water use conservation and biodiversity. And that is because there is greater recognition of the multiple ecological outcomes, if you will, of natural climate solutions, but also the corporations who have pressure from shareholders, stakeholders, customers, consumers are being pushed to be transparent and record and report their impact on all of those ecological outcomes. So we will see a lot more demand there in the future. We've already seen that go up exponentially in just a couple of years. I'm just hoping that the accounting and reporting systems that are evolving will account for those in an integrated fashion. Right now, we're seeing parallel efforts, right? With SBTI, for instance, accounting for carbon, and SBTN accounting for water risk and then biodiversity. Those accounting systems, those reporting standards need to come together because corporates need to be able to account for it and report it together. We can stack or disaggregate credits, and we have been, and we're seeing a lot more demand for stacked credits from corporations for those reasons.
Maybe just quickly comment, and we've been looking at quite a bit the context of a new European Forestry and Tree Crop Fund, and I think our finding though is that the tools for measuring reporting biodiversity are much less developed than those for carbon and greenhouse gas emissions. You know, we're looking for practical tools, third-party services we can pay for and use. And I think what we're finding on at one level you have some very sort of abstract model-based tools which give you some quite broad answers. You're always wondering, is it really accurate? Or you're going then into this in-field measurement by sort of PhDs walking around counting insects, which is extraordinarily expensive to do at any scale. And so I think there's still a gap there for cost-efficient biodiversity monitoring tools, where I think it's probably like at least 5 to 10 years behind what's been happening with carbon. And that's probably a function of the amount of energy and resources that come into it, because I think it is a more recent phenomenon, and we also see that too with investor interest. I think someone mentioned the TFND, the Task Force on Nature-Related Disclosures, in the chat. I mean, that's again a sign of that. It's almost like maybe the new COPs and biodiversity will have to go too soon.
Well, that's it. And I think until some of these markets, Paul, become regulated, if there's regulation in this space, that will demand the sorts of reporting and mechanisms you're talking about in terms of demonstration and validation of performance. So I guess that's going to evolve. Sarah, did you have another question that you wanted us to address there?
Well, Paul, you mentioned the TFND. Do you want to just address that question? That was, what role does agriculture have in that? Or do you have comments on that?
Yeah, I mean, I think a huge role, clearly, and we're still studying it. I think I think again that probably exists a little bit at such a high level that how do you actually translate that and apply it practically on the ground, either as a farmer or a forester or as an investor or manager, of assets in that space. And so I think we haven't quite worked it out. I'll be very honest about it, how we could apply. But I think our goal is that our new strategies that if we can develop the property level on the ground monitoring and reporting tools, make sure that aligns them with those sort of the highest level initiatives, such as the Task Force on Nature Disclosures and other initiatives. But I think, it's still, plenty of work to be done and by groups like ours and many others in the sector.
Great. I'll just keep going, Bert, unless you cut me off here with audience questions. And I'll shift gears just a little bit. Debbie, this one was for you. This person wants to know that he works with, I think it's a him, sorry. I work with a lot of large acreage ranchers and farmers in the US West, a lot of chatter out there about carbon markets. What are you seeing as the best prospects in the works for ramping up this market, and anything potentially in the Climate Bill or Department of Ag, CCC, and or Farm Bill?
Yeah, so I'll say we have more challenges in rangeland systems than we do in cropping land systems for a host of reasons, but particularly in the West. So what you can do to actually manage livestock and grazing is different than what you can do in cropland. You have fewer options to choose from. There is great opportunity for increased soil carbon, for instance, but that is very place-based. In the more arid Western systems, where you don't have as much moisture, it's harder to do, right? So that's one issue. We just don't have the same amount of data in grazing and grassland and pastureland systems that we do for cropping systems to really be able to quantify with great certainty the impacts and the outcomes there. There are some systems like AMP grazing and rotational grazing that are showing to be of great promise, particularly increasing soil carbon. They are hard to actually get a lot of ranchers to adopt, number one, and it takes a lot of time to actually begin to see the outcomes, even on a per acre or a full ranch opportunity. What we're seeing with investments in USDA, through the legislation that just passed and legislation being contemplated, is in fact increased research, right, to focus on how we better quantify those impacts in rangeland systems, but also other opportunities we can focus on. There are things, methane has been mentioned here. Can we provide, feed additives to cattle, for instance, that will have a much greater impact with methane? Can we come up with alternative manure management solutions? So I think there's a lot that can be done, but there's more research needed, particularly in those grazing land systems than what we've seen in cropland systems.
I think if I can just add a piece there, Sarah, I mean, I think what you find in the farmland and cropping systems is that the analytics around soil data and continued performance, because that information gets captured because those sorts of farmers are looking to make those improvements in their soils, and whether it's an agronomist doing it on their behalf or whatnot, an input company, that data is there, where in the rangeland systems, I mean, the requirements and or the practices and the disciplines around measuring soils has probably just not quite been there. And let's face it, in the west of in the West USA, some of those landscapes, they're hard to get to access. I mean, there's some steep country here. I mean, taking soil samples in this part of the world is not easy.
Yeah. Very good point. And you must be doing that right now, right? Out in Montana. Are you doing some of that?
Well, it's really dry. I got to tell you, taking soil samples is kind of tough at the moment.
Following up on kind of the carbon conversation here, Debbie, probably this is for you first, is what role do you see blockchain playing in global carbon accounting, or any role?
Yeah, so I think digitization, right, and potentially blockchain can really help track data. And also, if you think about it from a market context, which is where I'm coming from, if you can encrypt and securely encrypt and capture data associated with a project, for instance, right, and associate that with credits, you can actually create a means of tracking the quality and all of the data behind a credit or a pool of credits. There is movement in that direction, and we've been actually working on some systems to help generate that level of encrypted, secured data to follow credits, if you will. I think we're going to see a lot more of that in the future, and I think it'll help streamline, scale these markets, do a better job of capturing data behind the credits, and provide more certainty than we can perhaps provide today.
Great, thank you. Okay, this is coming from one of our very own RFSI teammates. If the agriculture sector were to work across sector to set goals, targets, like we were talking about airlines doing, what should we focus on in leading those conversations, and what outcomes would be the focus? This is open to any of you who have a thought on this.
I can start. So I think the most important thing is we all know, like, generally where emissions are coming from within agriculture, right? And what the opportunity sets are for reducing the emissions if you're focusing on, CO2, soil carbon, nitrous oxide, and methane, right? I think aligning how sectors approach both mitigation opportunities, adaptation opportunities, and then collect data, track the data is an important thing, right? Collective investments that enable everyone to do a better job. But then sharing place-based information, because what happens or what can happen and move the needle in one region, we were just talking about, the West, the dry West in grazing land systems in the United States, is different than what will happen or create real change in other places. So we have to have a much better handle in these biological agricultural systems on what moves the needle and what moves the needle where, and then share that information so that we're actually focusing our investments and our efforts on where we know we have the greatest impact. Some of it, it will be a shot in the dark, but I think that collective sharing of information and impacts is really necessary to adopt a sectoral approach, for instance, in agriculture, that can then create the right incentives and then investments to actually create change across the entire sector globally.
And I think, oh, sorry, Paul. I was just going to say, I think starting out, it's too also about how to get to neutrality first. So first you've got to understand what your baseline emissions are and or do life cycle assessment. So once you can understand your inside the farm gate, as an example, emissions and how you got there, that's, to me, that's kind of where a sector's got to get to. And then it's like, okay, if we're going to start drawing down carbon and contributing and taking that additional carbon to offset other emissions, whether it's within industry or across, and then how do you share that information, to Debbie's point, around the practices that it takes, the practice change to sequester that carbon. So I think it's sharing information, but it's also sharing practices and experience, because you've got to understand your emissions, your baseline, you've got to understand what it takes to get to neutrality, and then you've got to understand, how can I do my bit in terms of sequestration, and what will I do with the surplus? Will I, is that going to go within my industry, or am I going to try and monetize that within the carbon markets?
Yeah, and just building I think Bert's right. I mean, I think the best place to start, you have those natural farmer networks, because what we're trying to achieve usually is change in farming practices. One thing we certainly found is farmers learn most from and listen most to other farmers. That's how you get change in agriculture, is you sort of informal or formal networks of practice and innovation, and people copying other and seeing what they do. And then I think there's natural groupings where people who are a single farming systems, whether that's going to be corn, soy land in the US Midwest, or beef cattle farmers in Australia and Queensland, or almond growers in California. So there's lots of kind of natural, almost commodity-based groupings, and we've seen it already to an extent in more tropical commodities, to maybe not always to great success, but sustainable palm oil groups, sustainable soybean groups. So I think it's probably, there's even more examples of that in the tropical commodity world, where there's been a clear link with deforestation and a lot more kind of pressure and focus for over a decade.
I'll just throw a question out, actually, if I can. One of the things that I think we struggle with in Australia as we make this transition is the tendency or the potential for large swathes of agricultural land to be bought up by people simply wanting to use 100% of it for carbon sequestration. And what does that do to food security and the agricultural industry? And I think that is where government probably need to step in at the start, and then probably leave the rest to private industry. But just to make sure that we're not losing food. Yeah.
No, it's a great question, actually, and a point, because and we saw that one of the projects we had, where we pretty large set of properties we acquired in Western Queensland, we were able to put in place a large carbon project around regeneration of native woodlands, but it was very much a working cattle property as well. So I think we've always tried to strive to find ways that you can have working lands, working farmers on that land, or foresters, harvesting timber, and still be able to store the carbon. I think that's long term the best solution. Otherwise, you're going to have a lot of community pushback, and investors will run scared too, because they have a lot of PR risk around that as well.
Yeah, and I think, Katrina, we're going to start to see some changes in land use change, to your point, in Australia, whereby whether it's, and carbon may be driving this a little bit, whether it's the integration of a timber project and an agricultural project. So let's just say the best timberland assets, as a generalization, may have already bought up and be planted down to timber right now. But because the carbon markets have kind of changed the potential opportunities here, does that mean we're going to push into areas that has a portion of timber country that's suited from a land class and climate point of view, but there's also some integration for livestock in the areas within one asset that are not suited to forestry? So I think we're going to see some creativity around how these assets are viewed and managed at the enterprise level moving forward, because I think carbon has probably made some of these opportunities more viable now.
Yeah.
I hate to even weigh into this, but I do think this is an area where government intervention is probably necessary, right? Because you get into like sovereign interest, you get into an ability of an economy to retain enough natural lands and working agricultural lands to actually support themselves and their economies. And I think we all need to be thinking about it. I think California is a good example. California was really addressing, when they started their cap and trade program, like the highest emitting sectors. and 10 years in figured out, our baseline has actually been going up because we're losing agricultural land at such a rate that we're losing carbon, and there are other land use impacts associated with that, right? We need to learn from that lesson and consider land use change and how and where we allow that change to happen from perhaps a government perspective. And again, I hate to say that because in many cases we're talking private land, but there are repercussions if we don't actually focus on land use change and how we use it to mitigate carbon or grow crops or other things.
Yeah.
Well, I was just going to say, and Debbie, it's really interesting, whereby the government in the US, as an example, owns such a, whether it's federal or state, BLM or state land, they are big custodians of land in this country. So in the US, how are they going to start thinking about change, and how are they thinking about, building natural capital, and are they going to be prepared for private landowners to start integrating some of these practices and, God forbid, have a carbon project on some BLM land?
You can't sell from BLM land.
I think we're getting a really interesting topic here about sort of, again, big structural shifts, which are not even all around carbon markets, but again, we believe that this shift to a circular bioeconomy is going to happen, should happen, and I think we will see landscape change. I think we will see a shift from annual crops to perennial crops. So more orchards, more agroforestry systems. We will see a shift from marginal grazing land to forestry. And that latter piece is very interesting in Ireland, where we're active, and I'm from, so it's very close to my heart. Where there are large areas of marginal farming grazing land where it's fairly unprofitable to raise cattle and sheep. Forestry is a better economic, gets you use of that land. It also delivers a lot of climate benefits, so it makes logical sense on paper. But if you come in and you start planting citrus fruits monocultures, plantations, local people don't always like it. It changes landscapes. Those management styles can be somewhat brutal. There's a lot of culture factors at work. So how do we ensure that sort of shift to more trees in the landscape is done in a more ecological way? I think it's a really important challenge. We're seeing a little bit in New Zealand, where actually carbon is driving massive afforestation of marginal grazing. Again, that kind of pushback. So I do think it's a bigger challenge. How do you bring rural communities along with this, and so they see those shifts as positive, as a source of income, a source of jobs, and sort of part of their future too.
Great. I have one. Tori just snuck in one last question, and then I had kind of a wrap-up question, unless you had one, Bert. Is that okay?
Go for it.
All right. So Tori wants to know what supports do land managers and farmers need to be able to participate in these existing and emerging markets we are discussing, especially as expectations for on-farm benefits increase. If scaling agriculture efforts to meet climate goals requires engaging the small and medium-sized operations, how do we remove barriers to their participation?
That's a very good question. I'm happy to have first little crack if you like. I mean, one of the major barriers, and in our experience in a regulated market, I'm just going to say in Australia, is cost. One of the major barriers is the cost of participation, whether it's the cost of baselining and sampling in a natural capital market. Paul spoke about the ambiguity and cost associated with measuring biodiversity. And there's also the knowledge gap, the information gap. It is really challenging for small, medium landholders to understand how to participate, who to trust, who to partner with. And I think there's a lot more work to be done around supporting small, medium landholders, because let's face it, in a lot of these agricultural systems, they still are the majority landowners across the continents that we're talking about. So how do you support them with information and with technology and opportunity? And does this go back to our discussion around government intervention around supporting not only the resources to participate, but also education resources and all those sorts of things that are required to help people not only understand how to participate in the market, but how to participate in practice change. What's it going to take to generate natural capital? So education, financial resources, and a network of people they can trust.
Those are great. Anything to add, team?
Can I put in a word for cooperatives? You know, I think actually that some of the challenges that Bert mentioned there are something actually farmers have always struggled with. What you typically have lots of farmers who are buying inputs from a small number of companies and selling product to a small number of companies. So they're always structurally squeezed and at the mercy of bigger players. And, you know, and farmers, I think, over a long period have recognized the only way to deal with that is to aggregate and come together and do things together. And cooperatives have played an important role in that. Certainly, again, looking at dairy cooperatives in Ireland, I know very well, but there's other examples around the world. So, you know, there could be a role there where, you know, farmers can come together, aggregate, you know, and enter into projects, you know, together to drive those costs down and get the sort of scale and volume. But I completely agree, the scale and the volume is the other thing, because you talk to the corporate investors who want carbon, they want lots of carbon. You know, so there's an RFP that just came out a few weeks ago and is looking for, you know, 500,000 tons of CO2 per year.
Yeah.
You know, that's a lot of acres, a lot of hectares, and it's not going to come from one grower. It's like thousands of growers. So we need some kind of aggregation mechanisms to link up these multiple small projects with these big buyers. Well, that's what Debbie's working on, so she can probably speak to it.
Yeah, well, so I would add and maybe put a finer point on the financing, right? So markets pay for credits generated after the fact, right? Because they have to be you have to create the credit, quantify it, verify it, certify it, put it on the market, right? What is really needed is upfront financing for producers, right? Even if you pay for some of the credits up front, that can help them actually change the practices, buy new pieces of equipment if they need to do that. So the temporal elements of this are as important as what we bring to the table. Bert also brought up education. Like if a farmer and rancher knows in their region what they can do to get the most credit, for instance, if you're participating in a market, that can really help them, because if they undertake one practice change on part of their farm and they say, I didn't get a lot of money out of that, they might just walk away. So if you improve their experience and their expectations, you might actually build a better appetite for participation in markets over time.
All great comments. Thank you. All right. In closing, we have just a few minutes left. I'd like each of you to respond if you can. What do you think is feasibly possible to accomplish before COP27? And I bet this is separate, but maybe not. What would you like to see happen? What is the more intrinsic? Who wants to go first?
I can start.
Go ahead.
The governments have intercessionals, like meetings between the COPs, right? Where they try to make progress. I think if they focused on like one or two big things, resolving Article 6 and the remaining things in Article 6, and really put their wheel to one or two of those, rather than trying to eat the elephant whole, I think we could see more progress, right? And identify, we know basically where every country's stance is and has been for 26 years on issues, like identify who we need to bring to the table and what incentives they need for one or two big things that can make a huge dent at COP27, right? I think part of our problem is trying to eat the elephant whole, right? Instead of identifying those near-term things we can really resolve at COP27.
Thanks.
I quite like Debbie's idea of focusing on Article 6, which we negotiated at intergovernmental level, and actually defining how that now interrelates with the private sector level, especially when it comes to voluntary carbon markets, and to finally sort of clear up some of this confusion around double counting and usability and of credits. I think that could help unlock some of these voluntary carbon markets that are relevant to agriculture and forestry, where outside of the place like Australia and New Zealand, where there already are, let's say, more regulated markets in place. So, and that seems something that probably is achievable in 12 months. It's sort of a technical piece of work that's required.
I'll go along that bandwagon. I think having a really clear vision ultimately of how we trade carbon units across the globe will be helpful. I do not think that there will be one price for every carbon unit, but I think it would be great if we could have a base price. I come from a background of credit default swaps, and in those you have what's called a cheapest to deliver, and then other other credit default swaps on the same company may trade at different prices above that, but the cheapest to deliver is the one that's traded on the market. And I think that would be a way to get this premiumization sort of better understood by the market. We saw an example of that domestically recently, where our largest telecommunications company wanted to buy some net zero offsets. They didn't buy them all domestically. They bought some from offshore and got huge shareholder backlash. So being able to have stories around why you bought the ones that you did is going to be different for everybody, and you will pay a higher price. But I think if we can get one price, the cheapest to deliver across the market and agreed, it would really help us deliver financial solutions going forward.
All right, we got time. We'll leave it one.
Okay. Well, I mean, I guess before next COP, I mean, I got to say, I'm not convinced governments and politicians are really, you know, I'll be in the ground before I think we see major change here. So I'm more of a capitalist and more focused on the private sector, and I'd like to see private sector lead corporates in changing the food system. I think that for me, that's something in terms of, can we get some things associated that are linked to COP that are going to advance and progress our food system, so that, you know, I think we can knock a few things off at once, whether it's our methane emissions, whether it's, you know, food miles, whether it's how we manage nature, getting money back in the farm gate for farmers around carbon markets. I think if it's an agricultural focus with aligning of nature-based solutions and its markets, for me, I think that's real progress, because I think it has that enduring longer term impact for generations to come. And I guess that's, I'm a believer that private capital will lead this, private instigators will lead this. I don't have a huge amount of confidence in both developed and developing nations to really get together in the room and just get on with this. I mean, if we can't get China and the US to collaborate, you know, how are we going to get everyone else online as well? So anyway, that's my little soapbox, Sarah.
Awesome. Well, thank you all. I think that's just about all we have time for today. A big thanks to all of our participants today, and especially to Impact Ag Partners for this conversation and making it possible. So thank you, Bert, and to your wonderful team. You can learn even more about Impact Ag Partners online at impactag.com/AU. On behalf of our team at Regenerative Food Systems Investment, we thank you all for attending and participating today, and invite you to continue to engage with the RFSI community through our events, our newsletters, webinars, and our directory. You can learn more about that at rfsi-forum.com. We do have an upcoming webinar on December 1st as well, if you'd like to join us for that. And I will leave us in the last 2 minutes. Bert, did you have any closing comments you would like to share as we exit today?
No, Sarah, I'd just like to thank you and your team, and also in particular, Paul, Debbie, and Katrina for your time today. So thanks a lot. And I think we pulled together a great panel, and look forward to doing it again. Thanks a lot.
I agree. Thank you all. Have a wonderful day.